Good evening and welcome to the Accendo Traders Group. This is our 30-day stock market challenge, and we are on day 17. Day 17, 30-day challenge at AccendoTraders.com. We are focusing on learning how to develop our own personal trading system, but even the best of us, when we have our trading system based upon rules and criteria, when a market's like this, it feels like the greatest roller coaster around. And so, as we are learning how to trade, we're in a period of time where we're studying technical analysis, and we just finished moving averages, and now we're going into Bollinger Bands. So we're going to do a two-part series on Bollinger Bands. So first of all, what exactly are Bollinger Bands? You can kind of see in our picture here that we've got a moving average and some lines on the outside of the moving average. So what Bollinger Bands are is a band plotted 2 standard deviations away from a simple moving average. So this middle line here is the simple moving average, and these bands are 2 standard deviations away from that. Don't worry about the calculations about the standard deviation and what that means. Just understand that these lines are in relationship to the simple moving average. And so because we have these bands that are standard deviations away from the moving average, they're basically measuring the volatility of the stock, the volatility of the move of the stock. And because of that, the Bollinger Bands will adjust based upon the current market conditions. Here you can see that we can also use Bollinger Bands to do support and resistance, but we'll talk about that later. So the standard deviations, market volatility, what does that all mean? Well, in a period of time when a stock is volatile, and that means that there's volume coming in the stocks, either the buyers are pushing that stock higher or the sellers are pushing it lower, the bands begin to widen or spread apart and move away from that moving average. So here we are at point C, and we were consolidating for a bit. And as soon as the stock begins to push higher, you can see that we basically have an opening of our mouth, the opening of the bands. They're spreading apart, and the stock begins to push higher. And we call this walking in the band as it goes higher. And you can see that the bands have pushed away from the moving average. And down here as it's going up, and then as we get towards the top, you can see that it's basically now starting to contract and come back to the stock. So if the stocks push away during high volatile times, during less volatile period of times, it's often known that the bands contract, they tighten, they come closer together. Here we can see we got our spreading, the mouths open up, spread, and as the stock consolidates, that's another way to look at it. Less volatility equals consolidation, a stock that is channeling. And the bands tighten, they come back towards the moving average, and we have a stock building up, sort of like a spring. It's building up the volatility, it's getting ready to make a move, but we don't necessarily know which way it's going to break out. And so we call that tightening, and we call that preparation for that move, the Bollinger Band squeeze play, the calm before the storm. So as we look at this picture down here, I'm at the bottom left of the picture, and you can see we have a stock that's consolidating, and as we said, during this less volatile time, the bands come together, they're tightening, and then we call that squeezing, and then the stock pops, and it makes this move, consolidating again here, squeezing, and pops and makes another move. So basically, a Bollinger Band squeeze play happens when there's low volatility or a stock is consolidating. It indicates that there is a balance between the buyers and sellers involved with that stock. They're agreeing upon the price. Good place to sell, good place to buy. So we call it the calm before the storm because the bands are squeezing together, building up that volatility, building up that momentum, ready to pop and move. But again, we don't necessarily know which way that stock is going to move. So how do we use Bollinger Bands? Obviously, we've been talking about it. It is a measure of high and low volatility times. Again, while we're consolidating and we're squeezing, this is low volatility. The buyers and the sellers agree. And as we spread apart and break out, that is high volatility. We also use it to identify support and resistance. You can see in our little consolidation period here, it hits the top band, comes down to the bottom band, works its way back up to the top, works its way down to the bottom. So we can also use it to identify support and resistance. We can use it to confirm our trends. We can see that it walks the band, and we can tell it's in an uptrend. Now, we're going to show some examples in a moment here of the different types and how we can use different Bollinger Bands to help stay in a trade and not to get false signals. Finally, we can use Bollinger Bands as a trigger signal. Now, obviously, this squeeze play is something that we can trade, and that is a trigger signal when we get the opening, the widening of the bands. Also, we can use an exit signal as the stock pulls away from the band. That might be an exit signal, but we're going to get more specific about that, especially in our part. So to start, what I want to do is go ahead and talk about the different types of Bollinger Bands, the different settings for our Bollinger Bands. And as we talked about in our video here today, there is basic standard settings of a 2 standard deviation. So that's what we see here. We have our Bollinger Bands here in blue, and they're at a 2 standard deviation from our 20 moving average. Now you guys know I like the 10 exponential moving average, so I put that almost everywhere. But this setting, and we're looking at Google, back in October, November, December of last year. And this is how it looks on the standard setting. Next, we have what is called a fast setting for the Bollinger Bands. And I will give credit where credit is due. This is something that Marquet Latimer from Better Trades shared. I'm just going to hit say no. And here we have a 1.5 standard deviation, and then we change the moving average to be a 15. So you can see they're a little bit closer to the stock. If you remember on the other setting, the moving average, the Bollinger Bands were on the outside of the stock. This one's kind of going right through the stock on this move. Same thing going over here. Again, here's our standard setting. And, whoop, I got to scroll over just a little bit. And then when I go over to the faster setting, here's what we get there. So you can see the difference. Now, there's another somewhat commonplace setting for Bollinger Bands. You can see we still have a 2 standard deviation. However, the moving average is an 18 instead of a 20. That's another way to look at it. Not much big difference that you're going to get from the 20 setting. So I don't really use this one at all for the Bollinger Band part of it. I use some of the other things on this setting. Now the last thing I want to show you is another setting, and these are called momentum bands. And this is from Dave Elliott of First Wave. You know, those of you who watch my weekly trade plan videos, and sometimes I bring up Dave Elliott and what he's saying about the market. This has a 0.8 standard deviation, and I have a 10 for a moving average. So you can see now bands are inside of the stock move. Use these momentum bands as something to help us stay in the stock. Remember, what do we use Bollinger Bands for? To identify trends. This setting I use to say, all right, I can stay in the stock. Because if I go back to this one, you can see that the stock starts to break out and then kind of move in a little bit. Now, when we really talking about trading rules in our next video, our part 2 of this video, you'll say that we'll probably would have stayed in stock the whole way anyway. However, in this downtrend, when it starts pulling off, we might have gotten out of the stock. But when I use the momentum band setting and look at it here, I would have stayed in the stock because I can see that it never violated the momentum bands until it came here. And same thing going on here. So I use this momentum band setting to help keep me in the trade. I use the standard setting to help identify the trade. And you can use the momentos to do that also. That's kind of how I use them. So let's go ahead again and take a look at it one more time. Again, here we are in the standard setting. 2 standard deviation. I got a 20 moving average. Here it is, the Bollinger Bands kind of on the outside of the stock. Here we've got the squeeze play. The bands are spreading open and the stock heads up. Also notice again when we say the squeeze play, look what happened. The, low volatility, the bands have contracted, and the stock volatility on the inside is building up, and then we take off. Let's take a look at this in the next setting, and you see here's where we got the setting. And and we actually get this the entry signal on the fast setting a little bit earlier, and then another one here. Now you would have been in it for a couple of days longer, but you actually get this signal to get in here. So the fast setting, my point is that the fast setting for Bollinger Bands is for your high volatile stocks. Your high volatile stocks will work well with the fast settings. Now here we are on the downtrend. You can see we get the band spreading. Here the bands start to contract. When we get our spreading here and we're going to the downside, there we go. Let's look at that at the next setting. There we go. Got the signal a little bit sooner. And again, at the momentum band setting, you can see again that we would have stayed in the trade a little bit longer because the stock basically stayed all the way here to the outside. So our three settings that I like to use: standard deviation of 2, a 1.5 for a fast setting, and then a momentum band setting of a 0.8. That's it for this video. Check in tomorrow for part 2.